Hello, and welcome to the first of this four-part webinar series, which is hosted by Digbee, entitled The Responsible Mining Advantage. And I think the series is designed to really help mining companies not only understand how the rules of the investment landscape have changed over the last 10 or 15 years, where the new funds are coming from, and also what needs to be done in order to align with them and therefore ultimately to win under these new conditions. The first series will really be setting the scene to how the rules have changed, where the new funds are, what they're looking for, and how we can effectively align with that as a mining company. The second will be digging into how to create credibility and therefore enable us to better prepare, but also to engage with these different institutions and to some extent other stakeholders. Thirdly, we'll go up to the boardroom and to the management table and to how do we embed responsibility into strategy before we then look at life after verification and what benefits we can expect to get from that, and also the roadmap going forward from there. So today, let's just go into this fundamental change in the industry. Capital is no longer simply flowing to companies with good geology and technology and technicals, but we all recognize that those are absolute bedrock to ensure that any economic deposit then moves forward. But really where the money is really being attracted to is to great companies and management teams that can identify, can manage and mitigate risk, so that they can then communicate a more effective strategy to these different organizations. So let's just zoom out a little bit and understand where the industry's come from and where it is today. So first of all, pretty dismal numbers, looking where we've gone from in the last 20 odd years. The mining industry used to trade on a 10 to 13 or 14 times cash flow multiple with the diversifieds, and used to make up about 10 or so % of the world global equities or indexes. That's now sadly fallen to a 3 to 4 times cash flow multiple and just a meager 2.5% of the global equities. Now that's largely put the industry at the irrelevant stage, and that's the challenge that we've got to change. Now, there are a lot of ingredients on our side, and of course, foremost in that is that we've got geopolitics, we've got the gold price, we've got the energy transition, and the general compounding demand of critical minerals that we're beginning to realize. And this places the mining sector front and center, not only on the dining room table, but in terms of politics, and ultimately, and should be, and common sense dictates, should ultimately find fund flow coming into the mining industry. But that visibility also brings scrutiny, and scrutiny from a new group of investors looking for largely patient capital, looking to develop these assets and going forward. And the challenge the mining industry has really today is to recognize this change and align with these investors' requirements, and so that we can begin to attract that capital back. And the question the investors are largely asking is, can this company deliver responsibly? Can it do so on time without blowing up the budget, and also without impacting reputational risk through both social and environmental issues? And if we're on top of those issues, there's no reason why the challenge to move from irrelevance to relevance cannot be achieved. Investors really, I suppose, if you boil it down, are prioritizing companies that can show preparedness and not just show potential. Now, here's the challenge. The majority of mining companies in the junior space largely, and to some reason, with good reason, but most companies regard sustainability purely as a compliance and cost. It's just simply not the case. It's an investment signal to these groups, to these investors, who are looking to partner and therefore manage their portfolios in a risk-adjusted way so that they can deliver a project from development or early development stage all the way through to production. We consistently hear from capital providers such as private equity and project lenders that when they're doing their deep due diligence, they see too many companies that are simply completely unprepared for the requirements going forward. And they're totally unaware of the wall of requirements to mitigate risk as they develop these assets through to production. And even when the work is being done, quite often the value is lost. And the reason for that is because it's not being communicated clearly and it has no independent verification with which these companies can rely upon. And that really leads to slower decisions, valuation gaps, or being passed over entirely. But when I look at this and I kind of ask myself, well, show me some examples. I mean, the easiest example to say is just look at Agnico Eagle, which has risen to the most valuable gold company this week, not through its production profile, but through its valuation. And because its valuation has been driven by its consistent approach to being under-promising and over-delivering as a result of embedding sustainability into its business model and culture. And this goes back decades. It is not a novel position. But there are many other examples that we can effectively rely upon, both in the junior space, getting better prepared to access capital, as well as obviously communicating more effectively. You could look at the Lundin family of companies. You could look at Vino. You could look at a number of companies in terms of preparedness for development capital, such as Bunker Hill and others. So what investors really want to see today is, and let's be specific on the different segments of the investment community, is if you look at the generalist investors, what they're looking for is leadership mindset, a management team that can promote its strategy of risk mitigation, where there's credible risk strategy, social license to operate has been de-risked and is secure. And if we can communicate that in an easy and simple way with verification, they're on top of this. And a company going in and pitching for capital from that group will be in a far better position than its peers who have not thought about that before. The private equity space and the corporate lenders and project lenders, really they've embedded this for some decades. I mean, IFC and equator principles is not new. And really, I think where they're looking for is, as I mentioned earlier, is that a lot of these companies coming to them are totally unprepared. So how can we better prepare, understand what due diligence requirements are going to be needed, mitigate any risks that come up in that baseline assessment beforehand, and therefore then being able to promote or to tell that story in a much more credible and confident way when we go in looking for capital. Lastly, I think it's worth mentioning just the offtake as an increasingly part of the investment landscape, particularly for the critical mineral space. Now, I think it's fair to say that OEMs and others didn't really know what they were looking for when they started to increase their investment focus into the sector 3 or 4 years ago. But that has now changed. There's more structure behind it. There's better understanding. What has not changed is the absolute focus of attention in terms of what their bottom line is. And that is to ensure that the supply chain visibility and confidence in responsible sourcing is solid. And that very much goes back to reputational risk. What we're now just trying to move forward with is to have better structure, better understanding. And frankly, not only is it a reputational risk, but it is also very much consistent with other investors where they just want to see these assets developed responsibly and therefore obviously on time and on budget as well. That protects the investment. It also protects the reputational challenges. So I think it's probably fair to say that investors are gravitating towards management teams and companies that can back up their story with verified and consistent action. And that really brings me on to what companies can do in order to therefore align directly with these different groups. Well, first of all, let's get a baseline assessment done on all the different areas and topics of sustainability. So sustainability covers roughly 35 different topics. How can we relate them in a mining company setting, right-sized for effectively their size of the company, whether you're exploration, development or production, making sure that it is consistent with the size of the company and appropriate so that there is value add to be had on the ground and in the boardroom from day one from this baseline. Let's just look at a few of these topics. If you look at carbon, which covers a multitude of different areas, but where are you in terms of what you can do now? But really, I think what's really important is that aspirational position of when that mine gets into production. Where does it sit on the carbon curve, or where will it sit on the carbon curve? And what can you do to reduce or to get further down to the left-hand side? That's important because it's a strategic advantage. That's a really important strategic advantage which directly goes into the valuation of that asset. The second thing is to recognize that carbon tax is going to be part of the matrix as we go on. Private equity groups already include that as part of the valuation process. So to ignore that or not be aware of it now is putting you at a disadvantage. Granted, nobody quite knows where the carbon tax levies will effectively stand, but they are going to be included in different parts of the world. Water obviously covers a multitude of different areas, the use of it, the protection of it, the sharing of it, the waste or disposal of it, both on a commercial and domestic basis. And how do we effectively manage that today? But also, where does this mine sit within that, to some extent, a water curve, but also in terms of how we can connect that with our social license to operate as well. Social engagement, have we got on board with our engagement with our local communities early enough? That goes the same with government. What have we considered with regards to tailings, and recognizing that, even at exploration level, just to be aware of that a tailings dam or a dry heap is effectively going to be needed at some stage, just to be aware of that. And then obviously as we go further down through the matrix of going into development, then being clearer with our goals and aspirations with regards to that tailings plan. Rehabilitation, a critically important part that must never be forgotten, probably not as relevant at the exploration level, but certainly relevant once you get into development and designing a mine and going forward. It's a critical part today of not only any due diligence, but also permitting. I think it's worth just mentioning there are other areas such as cybersecurity, biodiversity mitigation, rising up the chart of focus almost every week at the moment. But cybersecurity, where we've seen so many different areas over the course of the last, or companies being affected by this over the last few months. So once we've got this baseline, we then need to make sure that we take value from that, so that we can mitigate risk and use that at the boardroom and management table in order to go forward. So embed responsibility into the decision making, into the mine design, ensuring that when this mine is built, that we can be deemed to be responsible and therefore create that value going forward. Value is not always in the eyes of MPV or whatever. It's also in terms of reducing risk within health and safety, biodiversity, and all these other topics we've just been talking about. It's very much multifunctional, and ultimately then comes back to the value and capability of that mine. When you go into M&A, you don't want to be penalised with potential issues going forward. What you want to do is to set your front foot forward and be confident that you have mitigated risk across the spectrum. So not only into mine design, but also into community engagement, government engagement. Have we got on top of this earlier? And also, have we considered sustainability in terms of the permitting? We can advance permitting times. I think this is a really key area where there's maybe a lack of confidence, but a number of governments have highlighted fast tracking of responsible critical mineral projects. And I think there's been some examples of that over the course of the last few weeks. So get on top of this and begin to integrate that so that we can take advantage of a new era evolving around permitting. The third important is verify. Independent verifications gives you credibility, clarity, and confidence. And with that, we can fully transform the confidence from the investor point of view in terms of delivering capital. And if you just remember the fact that investors can't reward what they can't see and trust. And I think that's really important, because if we've got an independent assessment that can be given out and there's a clear strategy with which they can read and understand and to some extent have a track record on, then that clearly adds value going forward when in those discussions. I think I just want to touch on how Digbee can help you on all of this. Well, we've worked with our over 40 companies with nearly 80 different assessments, and providing a mining-specific sustainability assessment that is very much right-sized for any company and project. And what I really love is the debrief calls that we get out of these and the impact that has been felt by the companies. Many CEOs or CFOs in some cases have said, I now better understand our company, and we now have a far stronger roadmap to a lower risk project, which helps obviously us internally from an efficiency point of view, but also de-risking it from our point of view, but also from investors and other stakeholders. To me, that really kind of is the salt of the earth of recognizing that sustainability, when done properly and when done from the bottom up, gives that value back to management teams so that they can effectively apply different strategies to end up with a better result. Our assessments are aligned to global standards, very much also right-sized for exploration, development and production, so that everybody gets something out of this right from the beginning in terms of just completing the submission, which we will of course help with wherever possible, but also in terms of then having the report back, having that right to respond and comment on it before we get a final report. These reports are not obligated to be published, but clearly transparency does help in terms of creating value. And so it is the decision of the company as to whether or not they go through with that. I think just in terms of summary of all of that, the ultimate goal from the Digbee assessment is to create value. We help reduce risk, we accelerate and improve the efficiency of due diligence. We build trust with stakeholders and capital providers. And I think if you bring all of that together, can we effectively move this sector from the irrelevant position of 2.5% of the MSCI or any other global index back up into a more acceptable level, nearer where we used to be in the old days? It's strong competition out there with different sectors such as tech and others, but the requirement of the metal industry and the mining industry is absolutely solid. The ingredients of good sustainability and responsibility are in principle in place. Now we just need to communicate that more effectively in order to access greater pools of capital that are definitely on the sidelines and are looking to invest throughout the matrix of production and development, which will ultimately flow into supporting the exploration world. So with that, I'll just finish off by saying our next webinar, look out for the invitation, but really we'll dig into how do we create credibility? What does it really mean by doing so? And how does that relate in the eyes of the investors? And really, I think our end goal with that is how do we get mining companies to stand out relative to their peers as a lower risk, better management team, which can effectively execute a strategy effectively over the course of the next few years in developing that mine and getting into production. So with that, I'll leave it there and open it for questions. And thank you very much indeed.
Hi everyone. You can see I've changed and put a suit on, so but I hope that was of interest. I'm just going to start off just before I take any questions and just say it was really informed after a article I read on McKinsey last night. Don't be afraid of sustainability. There's no downside. This is a strategic advantage for every single company. And where I got my inspiration to say that is the article was very much with an interview with the CEO of Nucor, which, if you don't know, is one of the kind of the bright spots of the materials industry, one of the great steel companies of America, which has very much been recycling steel for many, many decades, and has got a premium rating, is highly regarded in the Fortune 500. And the CEO, who's Leon Topolin, who I really want to meet one day, he basically was just highlighting that the founders of Nucor really embedded sustainability into the culture of the business right from the beginning, and went on to say that the risk mitigation that has evolved over time and allowed it to have a strategic advantage has been fantastic. So then I did a bit of research and I kind of thought, well, where's the steel industry? I mean, it's a cyclical industry like mining. It's old economy. It's dirty. It's capital intensive. It's got so many similarities to the sector, and of course very cyclical. And I suddenly noticed that it was about 3 or 4 times higher rated than the mining industry on a cash flow basis. So sure, there are lots of reasons why not, and all the rest of it. But I think it just highlights that that sector has really embraced sustainability. They've communicated it in a very clear and concise way. They've created a new strategy with regards to electric arc furnaces, which is clearly taking major shape in the world. You saw Nippon Steel last week announce a $9 billion investment into that. So it really kind of gave me inspiration to say this. Don't look at this as a negative or as a compliance. Use this as a value add for a sector, stand out from the peers, and really go for it. I just want to kind of bring that back down to earth to a kind of junior mining space. You know, Marimaca is just the copper company in Chile, has just completed a fundraising. And it did so at a zero, I think it was a zero, certainly low single digit discount to the price, to the market. Its cost of capital has substantially reduced over the last 3 or 4 years. You compare that to the average cost of capital for the sector, which is in double digits, 11, 12%, 13%. So I think there really is a value here which is not being recognized, and a real opportunity for companies to stand apart from the rest of the sector, move away from the old ways of communicating, and really what we need to focus on is inform, verify, and communicate. So with that, I don't know if there are any questions. There are a few questions that have come in, which I can see here. Do put a couple in if you want to. I'll just try and answer 1 or 2 of them. We've recently completed a roadshow with investors and we didn't receive 1 question on ESG. If you are so confident that sustainability is going to become a differentiator of value, then how do you tie these 2 statements together? Look, I think that's a fair point. I don't know what the roadshow who it was with, but if you look at the generalist investors, they're largely momentum players, and the whole world of ESG blew up. We can go into a discussion about that another time, but frankly, I see that as a positive, because a lot of that was rubbish. It was moving money into new economy sectors, which were green already, and moved away from the old economy sectors. And when that blew up, I think the remnants of that is now real risk reduction, as we've just been talking about. And I think investors, or the generalist investors, are largely kind of followers of things. So they're not talking about this as an individual topic. But I pose this question to you. Do they value risk? Do you think they value risk? I mean, 83% of all companies that go through development go beyond budget or beyond time, and they go beyond budget by an average of 40, I think just over 40%. And it gets worse when you go over $1 billion capex. So 17% of companies roughly meet their budget. No wonder the industry is in the straits it is in. And therefore, I would argue that if you can communicate credibly, verifying your position, a strong strategy which is risk mitigated, they're certainly going to value that. Another question is, if transparency is now a prerequisite for capital, why are so many mining companies still treating ESG like a compliance checkbox? This is frustrating for me. The general view in the sector is that sustainability is a compliance issue. Yes, there are elements of it. No, it is not the primary goal. The primary goal is to lower risk across a whole spectrum of topics. And if we can get that spectrum into a lower risk, which therefore improves our permitting, improves our social license to operate, et cetera, combined with the lower risk on the technicals to build a mine that is economically powerful, then we've got a really fantastic investment opportunity. So it is frustrating. I come across this all the time, but ultimately is answering questions in a framework such as Digbee's and able to communicate something with the credibility of an independent assessment. Is that providing internally the ability and the roadmap with which to effectively set yourself up for production in a lower, in a responsible fashion. And if that is, then we don't have to worry about the compliance side. It still has to be done, but we've added the value in at the beginning. How are institutional investors differentiating between credible ESG efforts and greenwashing in mining? And what evidence are they really looking for? So I think the problem with greenwashing, I mentioned this, I think just now in the talk, is a lot of companies are pulling back now from disclosure. And as a result of that, as a result of the greenwashing issues. And I think that is a major step back for the industry. We're not embracing it. We're not giving the information. But at the same time, companies need to be protected with what they're saying to investors and obviously the regulators. So institutional investors, how do they differentiate in this regard? Ultimately, if you're presenting a credible strategy that has been identified its risks going forward, with strategies that have reduced those or continue to reduce those, then they effectively will be attracted to a lower risk environment. I think one example which came up the other day is a copper development company, not Marimaca in this case, but a copper development company was going forward with a potential fundraising and just wanted to go ahead with this, and they got they started doing something rather different. They brought in 2 institutional investors and their local community into the same room. They put out all of their plans, but they also highlighted the areas that they had not got results for. They had not got answers for, and they asked for a very open discussion on this. And this could have really backfired in my mind. But what happened was that they came out with some solutions, not all the solutions, but they came out with some solutions. And the investors then came to them at the end and said, or a few weeks later, whenever it was, and said, now I really know that you're on top of this risk thing. You're being completely honest and open and trying to work through these things to effectively get a social license to operate on one side, and ultimately they gave the finance on the other side to backstop the to lead on the financing. So I think that's a really interesting angle about trying to communicate in a different way and trying to address questions in a different way. Lastly, I think there's one here. Given the shift in investor expectations, what's the biggest risk for a mining CEO who sticks to the old playbook? Well, the old playbook is we stay where we are. I mean, 3-4 times cash flow, finance is difficult. We're not attracting new capital. The cost of capital is double digits. So the risk is really quite straightforward, to me anyway, is either you get on board with this, embrace it, and get all the benefits of better access to capital and a lower cost, or you effectively get increasingly marginalized. And what I mean by that is I truly see the likelihood of, or not the likelihood, the movement of travel here being a differentiation between those that are embracing and those that are not. Why? Because it makes sense. It makes complete sense that we mine responsibly so that we can communicate all of this hard work, which much industry has been doing for so long, but to communicate it in a credible way, which is verified, to raise trust and confidence that allows, therefore, investors and others to come into the industry with a stronger sense of purpose, but also confidence that these assets are going to get developed on time and on budget. That wins out for everybody: the company, the management team, the shareholders, the communities, the regulators, the off-takers and all. So to me, I'll finish on that. If there's any other questions, by all means, email me or get a hold of me on LinkedIn. And I really appreciate everybody spending the afternoon for 20 minutes or so here today. And look out for the invitation for next week. All the best.